Yeah, as we covered off in the previous video, that with record low interest rates, this means that borrowing money has become extremely cheap. I only saw on the news last night that there was a home loan would be a first year introductory rate at 4.64%. So that's probably the lowest I can remember ever seeing, and probably not just a person my age, but generations have never seen interest rates that low. I speak to many clients that do remember when interest rates were 18 and 20%, and they were struggling to get by on their loans and their business loans. So the effect that all this cheap money has had on share markets is that as people become very disappointed with the low income they're receiving from their cash and their term deposit, generally what happens in this part of the cycle where interest rates are low, people start to gravitate towards the share market to increase their income by, say, some of the bank stocks will provide an income of around 5% even before the tax credits come in. So this is where the share market all of a sudden looks more attractive, and there's a push on the prices, and people start to bid up the prices in the share market. And it's a similar effect on the property side of things. On residential property, we've seen property prices go up considerably over the years, and that's been pushed up, probably not by great returns. I don't see any property prices, particularly residential investments, that have fantastic rates of return. Once you take off rates and all the insurances, the net return, at least locally, works out around 3.5%, so around the same amount as a term deposit. But it's the low interest costs, the low cost of debt to buy these properties that make it quite attractive, in the hope that these prices can go up over the years in value. Now that's my issue. I do worry that in recent times, the last couple of years, the share market's been pushed up considerably after some pretty significant lows, and probably the property market has been, we've really seen very little or no downside there in the last probably 15 years. So the valuations of the property sector do worry me, and what also worries me around that sector is the amount of debt it takes to purchase a property and the lack of diversification that people have when they invest into that area. So we're treading reasonably careful around the share market, and we do have a preference for international equities at this point in time, but we're not doing much buying, and we're particularly wary around the property market.